All right. And it's Friday and we are live. We're the Friday before Thanksgiving and all exciting here. Welcome, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. And today I'm joined with my good friend, Phil Weiss. Hey, Phil.
Hey, Kirk, happy Friday.
Happy Friday. We are, once again, the Friday before Thanksgiving. It's a little different from the Friday after Thanksgiving. That one's
Yes.
kind of an S show, and I certainly never leave the house because I'm afraid I'm going to get beat up when I'm on my way to go get something at the store. Uh, I still don't understand why people engage in that. It's like people go out there so they can get in fights, fight for stuff that's in discount. Like, how big are the discounts? Are they like $5 off? Or are they free? Like, if they're free, I'll throw some haymakers out there for free TV. But I'm pretty sure they're not free. So I don't know what happens. But God, the hilarity that ensues. It's like a Benny Hill video music. You put that on in the background, you see people
Yes.
piling on each other for the TVs. It's crazy.
I do remember when our kids were younger, the worst we ever did was one night we lined up at some video game store, it might have been GameStop or one of those kind of places, to get something for one of my kids. And we lined up like the night before, waiting for them. They were open at midnight. So we must have got there like at 9 o'clock at night so we could get in and get what he wanted.
Yeah, I don't know. Being a parent's tough.
Yes.
Yeah, I'm not. Yeah, I'm not sure that my maybe when I was younger, I probably could take a few punches for a free TV, but right now, take it. You got it. You earned it.
I hear you.
You know what I mean? But anyway, so I guess let's dive into it. So we got a few things we're going to talk about. Certainly we're getting a little bit of a hangover from the Trump trade. We talked about it last week on how the day that it was announced that Trump won, the markets reacted in a very bullish and positive way. But most importantly, the way it reacted was the most important thing. So international got crushed. U.S. markets were up a lot. Banks especially did well. Technology did well. Virtually everything did well, but especially banks, which I thought was telling. And we interviewed a bank analyst, which should come out any day. But what's interesting is looking at that day after and seeing what performed, how it performed. I wish I'd taken a snapshot. I usually do, but for whatever reason, I don't know, like technology gremlins ate it. But looking at that's really helpful because it'll illustrate what the market's thinking. Now, what we're seeing now, or at least for the past week, we saw kind of I guess a hangover from the Trump trade. So things started to go down. They started to come back more into line with expectations of what you'd think is normal. But we are heading into Thanksgiving, and things can be a little bit weird around Thanksgiving. But pretty much from after Thanksgiving until usually right through the end of January, you get the Santa Claus rally that does pretty well. And I don't know if that's going to happen this year. What do you think, Phil? Do you think we're gonna have a Santa Claus rally for the next 2 months, or what are you seeing?
I tend to think we are. I know that the past doesn't always predict what's going to happen in the future, but when you look at the fact that we typically have a Santa Claus rally and the fact that the market's been so strong this year, and the data that I've seen says that when you have a really strong first 10, 11 months of the year, that it ends on a strong note as well. So that kind of bodes well for it. I tend to think that, yes, we are going to have some type of Santa Claus rally. I know we had a little bit of a pullback, but this is a weird week. And next week is even weirder, right? Because we have a half a day on Wednesday. We have Thursday, the market's closed, I guess, or maybe it's not half a day on Wednesday. I know Friday's a half a day, but it's not a full week of trading. And we got a lot of people reacting different ways. And not everybody's around. Even if the market's open next week, you have a lot of people that aren't working. So it's a very different week for the market. It doesn't necessarily mean anything for what's going to come after that.
Yeah, it's interesting. I'm looking at the 1 week performance here of the markets this week, and it's interesting because yesterday technology was down across the board. I think there was only one tech stock that was up. I think it might have been Nvidia and it was only up a little bit, but all the rest of the big tech were down. I'm looking here and I'm just seeing the week. Target's down 18%. I haven't looked as to why because I don't
Bad
follow
earnings.
Target.
Their
Bad
earnings
earnings.
and their
Okay.
guidance were really bad.
Yeah. Yeah, I wouldn't be surprised if you're down 18%. It's got to be a whole lot of stuff coming out in the wash there. Bad earnings. Maybe the CEO was diddling a dog or something. Like that's been really bad to be down 18% in this market. And then you've got Intuit's down a little bit, but mostly tech is up. If I look here, Google's down 4% for the week. Amazon's down 2.5 going into what would be Black Friday next week. So, HCA Healthcare is down 5. Overall, the markets are up, so it's not bad. You just have this one little outlier. I mean, Walmart's up 7% for the week. Costco's up 6. So Target kind of being an outlier. I'm curious. I don't know if you saw the earnings, Phil, but I'm curious why they were so disconnected from their peers.
I mean, I know I saw the headline. That's why I knew that it was earnings related, but I'm going to look it up real quick.
All right. We'll come back to that. But I did want to just kind of point out as we get into the end of the year, things do get a little squirrely. And you should start to think about, as I look here, let's see the one-day performance. I'm seeing if I can pull this out, but no, they don't have that. I mean, if you look at the futures market, we're having kind of a weird time too. Futures aren't really excelling, although in the last 2 days they've looked good. But if you look at certain, while you're looking that up, there's certain things that stuck out. I'm going to pivot into this one thing, and we can come back. In the last few days, it's been really interesting. So as of yesterday, I believe it was, there is now a Bitcoin option traded for the IBIT. I don't know if others have it. I just saw the news that IBIT came out, and I haven't looked at the numbers because there's no way in heck I am doing an option on Bitcoin a day or day after it comes out. That's just crazy. But the numbers somebody told me was basically for the 1 month option for Bitcoin, in order to break even, you'd have to have a 100% return in order to break even in a month. Now, that may happen. It is Bitcoin, for God's sakes. Anything could happen. But I find those odds to be quite unappealing, and I'll happily sit in the sidelines till cooler heads prevail. But if you think that it's going to go up 100% and you're going to make money, I applaud your effort there. Kudos to you. You've got bigger and more brass things than me, and I just not interested. But I will say it is interesting. If you really want to understand options and their usage, what you'll realize is once options become efficient, which I'm pretty sure day 1, day 2 they're not, but once they become efficient and people kind of settle on a balance of what the risk is in the position, it does give you a pretty good indication of where the markets are going in that security. Because if they're assuming it's going up 100% in the next month, what that means is one of two things. Either way too many people are getting greedy on crypto, or it means that it's a pretty good bet that it's going up 100% in the next month. Now, I'm going to take the former. I think the latter is really stupid at this point because it's brand new. But it is interesting to check out. So if you really want to get a sense of what the market thinks, look at the options market. Generally speaking, it'll be pricing in it's kind of like think of it this way. If you're betting on a sports event, right, there are odds. The bookies give you odds, right? It's like, it's 5-1 or, it's 3-2 odds or whatever the odds are for a team winning, right? Maybe they're giving you like 10 points to win, but the bookies create these odds, and the bookies are generally pretty spot on. There are times where you get way too many Patriots fans versus Bills fans. But generally speaking, for most events, the bookies are trying to even it out. So they're basically making what they call the VIG. They're making their percentage. They call it 5%. They don't want the Patriots to win so they can win a lot of money. They don't care who wins. So they're basically acting as market makers so everyone can make their bets, and then they're making that 5% spread off of all the bets. That's how they make their money. Now, Wall Street does the same thing. They don't care whether you win or lose. They just want you to play. And so if you look at the options market, it's pretty much the same way. The options are priced so that it comes out break even. Now, it obviously never does, but that's how. Well, I shouldn't say never. Sometimes it pegs at the end of the options price. They peg it to a certain price, but generally speaking, you're looking at the options market trying to accurately price in where the price is going to go for a certain security. Now, for crypto, Bitcoin is just under 100,000. So if the options market is pricing in, it's going to 200,000. Kudos to all of you who want Santa Claus to show up at your Christmas stocking with Bitcoin, because I just don't think that's going to happen. But it does bring in the play of Michael Saylor, who everyone's favorite whipping boy. Michael Saylor is the head of MicroStrategies, and his stock went for a big ride in the last week or two, and it went up a lot yesterday, and then it got crushed. I think it was down like 16, 18% at one point, but it absolutely got crushed. So it started up in the morning, and then it got crushed all afternoon, and now it's kind of going back. But basically, here's a guy who has Bitcoin on his balance sheet, and he's levering up Bitcoin, much like a central bank leverages up their assets, which I think is absolutely crazy. And this guy's got, bigger balls than anybody ever met. I would never do this. I think it's nuts, but I give him an A+ for his guts, because here's a guy who's doing exactly what the central bank is doing, and borrowing money and putting it into Bitcoin. And I'm sure it'll all blow up at some point, but good on him. He could very easily become the next Warren Buffett in terms of wealth. It's either going to zero or he's beating Warren Buffett. That's my bet. But I do want to point out that there's a lot going on in the Bitcoin market. It's not all crypto markets, but definitely in Bitcoin. And I think part of it, I didn't see the news, but I heard about it, that apparently they're talking about putting Bitcoin as as part of the reserves for the U.S. as a reserve asset. Now, this has been talked about for a long time, so I don't know what came out that caused everybody to lose their mind, but this is not news. They've been talking about it for a long time. So I don't know. What are your thoughts on all this, Phil?
So the first thing I'll say about Bitcoin is, and those options, my view of options is that the ones who make the most money in options are the people that write them, not the people that buy them. And if that's the case, and if I had Bitcoin and there was that kind of premium or growth priced in, I want to be writing some of those options, because it seems like you're just going to collect the money and those options are going to expire worthless. You talked about MicroStrategy. Just today, it's gone the other direction. It's up 13.5% right now for today. A little bit of a volatile stock. Target, I Target, the earnings, it looks like they attributed to supply chain problems they had because of the Gulfport strike. They have an inventory glut. I mean, that company, I've looked at as an investment. It ebbs and flows. I mean, it's more volatile than your typical retailer. They have booms and busts, or whatever you want. Maybe that's too dramatic a word, but that one seems to go up and down a lot more than the bigger players.
Yeah, I think you're right. I think the port strike is just I think it's BS. I mean, why are they the only company that had that problem? I think it's an excuse. Now, if the whole industry is having a problem, I get it, and maybe it will impact them. But in my opinion, the strike didn't really happen. Like, it kind of happened, but then it was like, all right, we got an election coming up. Just go away and come back in January when we have an election, when we have a candidate. Biden's probably like, I don't want to deal with this. Can you guys just go away and fight with Trump? Because I'm too old. Like, I feel like that's what happened, because it did kind of go away and these guys really wanted to fight. So I think it'll probably come back after the holidays. But of course, at the same time, you're talking about who gives a crap, because the holidays are over, and the big buying season's right now. If they really wanted to barter a deal, that's what they would have done. So I'm sure there was some sweetheart deal baked in there to go away, but I think that's going to be an event probably in January when it comes back. I did want to point this out, because this is a post that somebody sent me. The first day IBIT options are just shy of 1.9 billion in notional trading exposure, with 354,000 contracts. 289,000 were calls and 65,000 were puts. That's 4.1 to 1, whatever. It's 18% were puts and 82% were calls. So you were talking about how the winners are the ones that write calls. I think if I was doing a spread, that would be a great time to do a spread.
Mm.
If you really think Bitcoin's not going up in the next month, which I think probably, I'd find it hard to believe it's going to go up that much. So if you can write a call that far out and pull in the premium, that's great. I will say this though about your comment. It is common knowledge that the writers of options are the ones who make all the money. I I like math, and I've had people say that, and I've had people say, "Yeah, but does that mean everybody else lose money?" And it got me thinking that actually it's not really how it works. Um, because if you're writing options, you take in $1. If you buy the option, if you're doing it right, you should be making $3 on the upside. So you might say, yeah, the writers win more as a percentage, but they lose the same amount because otherwise you wouldn't have a market because all options go to zero. Like if you're buying Microsoft, it's a perpetual ownership, but options may have a month or 2 months, but at some point they all go to zero. So you can't have a market if everybody loses,
Well, isn't
right?
the isn't the argument that the option expires worthless, right? So like if I own Microsoft and Microsoft is trading, let's call it 410. I know
Mm-hmm.
it's somewhere around there. And I write an option, a call option on Microsoft at 420, and I
Mm-hmm.
get 50 cents for it. If Microsoft doesn't hit 420 between now and the time that option expires, I get my 50 cents and the writer lost. I mean, the buyer lost. And that's really it. It's that the option expires worthless and that they don't hit the strike price.
So, so think of it this way, Phil. So if you have, I'm going to see if I can find something here. So if you've got Microsoft, let's take Microsoft here, and I'm just sharing the screen here for all you audio viewers. So let's say we have the December Microsoft options. Okay, and right now Microsoft's trading at 414. We'll call it 415. Just make the numbers easy. So 415 is trading at the money. So at this stage, there is approximately a 50% chance that it will be in the money and a 50% chance that it's trading out of the money. Statistically speaking, that's how they work. Now,
Mhm.
the markets may not be pricing that. So I'm just talking about academia here, not real life. Um, so in academia, 50% chance that it'll go up, 50% chance is going to go down. Now, the market assumes one more than the other, so it tends to tilt. So if if the market's bullish, there's probably a greater than 50% chance it'll be up and less that it'll be down. But if you look here at the options chains, here on the we're looking at the Nasdaq just for reference, and it's looking here at all the options. Well, you've got anywhere from 375 up to 455. So if let's say it closes at 415 in a month, or this actually expires December 6th. This is actually a bad example, but here it is, December 20th. So December 20, use December 13th. It's not really the major one. But anyway, so you've got a whole bunch of these that are going to expire. Anything less than 415 will expire in the money.
Yep.
Anything more will expire out of the money. So out of the money will be worthless, and all that money goes to zero, and those people lose money. So you're correct. Writers of options will lose money. But what about all these people who are in the money?
Yeah, but if you look at the number of, assuming that that's the number of, I can't see it, but is that number there the number of contracts? Like you have 1,300 and something contracts at 435. So
That's
there's
It's the
more people
open
that have.
interest and volume. So there's
Oh, that's
yeah,
all right. So that's volume. So there's certainly more trading on the ones that are out of the money.
right. But I mean, so for the listeners, the way you should think about it is options are meant to manage risk. So you can, if like Phil was saying, if you're doing like covered calls, if you're writing a call option, you're effectively assuming that I'm giving up the upside in exchange for a little bit of premium or extra income. Now you wouldn't get any upside, so you'd be called away and you'd get your, in this case, $6. So you get $620 if in the next, well, it looks like in the next 2 weeks is December 6th expiration. So you're going to get $620 if Microsoft does not go higher than 415 in the next 2 weeks. So maybe that's a bet you want to make, right? In which case you get your $620, you keep your Microsoft shares, you're a winner. If it goes over that, they take your Microsoft shares for 415, so you'd sell them at that price. Even if it goes to 500, you only get 415, and you get your 620. So the question is who's really losing, right? Are the option writers the winners, or are they the losers? It's a market, and everything balances out. It's kind of like it's like bookies. They're not trying to lose money; they're trying to break even so they can make money on the trades. So I find it really hard to believe that everyone says that the people who have a higher probability of winning are people who write options. Well, the problem is you're making a lot less by that. Maybe that's correct, but you're making less. So if you balance it out, it balances out even. So I've never been able to have somebody show me statistically that that's the case. It's more of just kind of like rule of thumb, something to think about. But no one's ever put those numbers to paper. I've never seen it, and I've asked. So I don't know. It's what you're saying is what everybody thinks, but no one's ever proven that. So I'm not sure if that's correct.
I can't say if I've seen it for that. I know that a lot of them expire. It's based upon the idea that a lot of them expire worthless. Like it's not the ones that are 415, it's the ones that are 420, 425,
Right.
4 right and
Well, that's
above.
half of them, but the other half expire in the money. So you know what I
The,
mean? So it's like there's a
yeah,
whole bunch of them out there.
you have to also think about, like, when I think about how many, I'm sure that I'm not positive, but I would assume that a lot of those that were written that are in the money, they could easily have been leaps instead of conventional options, so that they were out there for a long time. Like there's lots of other factors, so
Of
it's
course.
not a simple answer, that's for sure.
Yeah. And that's something actually I'd love if we do get a lot of people listen to the show who are a little more advanced in their understanding of the markets. And if anyone has the data on this, love to see it. I've yet to see it, but actual data, not just hyperbole. But anyway, so curious. So I just wanted to flip through this and then we can go on to other topics. But this is the Ethereum market, which obviously did well in the Trump trade and has come back to this normal range, but it has not done as well as Bitcoin, which kind
Definitely
of
not.
soared. And I think a large part of this is there's two factors that have come into play with Bitcoin that I've seen that should impact the market. Now, the first is the election, which Trump was very strong on supporting Bitcoin. We'll see what happens, right? But very supportive of the crypto community. Harris was very lukewarm on it. I wouldn't say she was hot on it, and I wouldn't say she was cold. She was just kind of like, yeah, sure, I'll support them, but not in a Trump sort of way. So I think people took that as she's not pro Bitcoin. But if you look at this since the election, obviously everything has done very well. Now there's also two other factors here. You see these big spikes. One factor was that I think it was yesterday or 2 days ago that somebody came out and said we're going to have Bitcoin be a part uh, of our reserves, of our capital reserves as a country. So we have gold, we have treasuries, we have other assets on our balance sheet, or the Federal Reserve has on their balance sheet, I should say. And the talk is, well, we're gonna have Bitcoin as a reserve asset, and it's an interesting conversation because if you think about it, let me turn this off so you guys can look at Phil and I rather than that chart and the advertisements that they're not paying us for. Um, so, just saying. But if you think about like, what would that mean? So if they took, so what would be a reasonable amount? So I think at the max, it's like 19.5 million, or it's 19.5 now, and it gets to 21. I forget what the cap is, but somewhere around there. So we're really close to the cap, but let's say it's 21. So it's 21 million Bitcoin out there. How many are we going to buy? A million? Like at some point, what are you going to buy? 10? Like, and if you buy a million, right, and it's 100,000 a piece, whatever that comes out to, 100 trillion. I mean, whatever that is. My math. Anyway, so something like that, right? So, well, we're not going to do that. We don't have that much money. So the question is, how much are you going to buy? Is it going to be a meaningful amount that it actually will make a difference in the balance sheet? Because if Bitcoin goes from 100,000 to a million, well, that's going to help, right? That's great. It could go to zero, right? So you can't make it 50% of your balance sheet because that would be dangerous and irresponsible. Could you make it 5? Yeah, that might that might be reasonable, right? Because if it goes up 10x, now it's 50% of your balance sheet, and then you could sell it and make lots of money. So that's an idea. Um, but I also think like the market is pricing in like people are going to go crazy. What they're going to do is they're going to say, "Oh my God, the Fed or the U.S. government's going to go in and buy millions of Bitcoin, and it's going to drive the price way up. So we're going to go buy a bunch now." Well, how about this? They've already confiscated a ton of Bitcoin. So they don't have to go out in the market and buy it. They just take the confiscated Bitcoin and put it on their balance sheet. Problem solved. It doesn't move the market. It just means that someone else owns it, which technically they kind of own it in trust now because it's confiscated. But still, they could just say, "All right, we're taking this, and this is what we're going to do," and now it's on their balance sheet, and it wouldn't change the market at all. It's like if Phil and I exchanged Bitcoin in a private transaction, the market's never going to see it, and it's not going to impact the price. If every single person did that, you're never going to see it. It's not going to impact the price. So I do think that this is kind of a pipe dream to think that this is somehow going to be a great thing. It might be a great thing, but I don't think it's going to impact the price because that'd be really dumb for them to say, "All right, we're going to buy 100,000 Bitcoin in the next month," and then everyone jumps in and front runs the market and drives up to $1 million a coin. That'd be really dumb. Now, it's not to say that it wouldn't happen because the Fed does it all the time, right, Phil? I mean, the Fed announces, "Here's what we're going to do. We're going to buy a bunch of treasuries. We're going to buy assets. Here's exactly what we're going to do. Here's when we're going to do it. You can all front run us. Good luck." And everyone does it. So I'm not saying it won't happen because it happens every day, but it is an interesting perspective of how are they actually going to do this with such a big order. And then the next question is, what if other countries do it? And now is it just a reserve asset that countries own and we can't? And now it's priced through the roof. So all these really interesting questions. And that's one. I don't know what your thoughts are, Phil. I mean, I know you've been behind the scenes. You're a tax guy, but what are your thoughts on this idea?
I guess the biggest issue that I've always had with the idea that Bitcoin could be some type of reserve currency or any type of currency at all is the level of volatility that it has. To me, like I do think of it differently now than I did in the past because I think of it as an asset class, but I have a tough time thinking of it as any type of currency because it's just too much volatility all throughout its life. It's not just now. I mean, you used to hear the stories about people that paid for pizza with Bitcoin and all that kind of stuff. It's not even that, but it's just the idea that anything that fluctuates in value as much as Bitcoin does, it's hard for me to picture it as a currency. But like I said, I do think of it as an asset class in a way that I didn't used to because there's trillions of dollars in total market cap on Bitcoin. So you can't disregard it. It's there, but I just think of it as an asset class. And I have a tougher time, like I said, getting to it as a currency. I do think, like you said, when these things are telegraphed, they have less impact. Usually they have a fast impact. Like if you think about when a stock's added to the S&P 500, right? They announce it a week or two before it happens, and the stock, whatever stocks are getting added go up, whatever stocks are coming out go down. And then after that, it normalizes. So it's usually just a short-term effect, not a long-term one.
Yeah, it's interesting. I mean, the other thing that we talked about was the Michael Saylor effect, and Michael Saylor came out because we talked about his craziness, and actually, I'll put the chart here on the show so you can see actually what's happened. And you can see here that it's gone up, and then the Trump trade, I think he announced that he was going to buy a bunch more Bitcoin. So my understanding was going to buy like 300 million in Bitcoin or some crazy amount. So he borrowed money and was going to go buy it, and then it's gone through the roof. And I think as of today, I saw a tweet or a post on X that said that it's now it's valued at 300% more than the Bitcoin he has in his balance sheet. So it's kind of like, all right, things have gotten away from themselves. But I do point this out because his strategy is basically, I'm going to get a loan out for a whole bunch of money. I'm going to go buy a bunch of Bitcoin. With that loan, the loan I'm going to pay like 3 or 4% a year. Bitcoin's going to go up a few 100% a year. And I'm going to make the spread, which I think is a really smart move, except for the fact that you're hugely leveraging your company. Which is basically what the Federal Reserve and banks do. Banks are, basically levering their balance sheet. And so if he keeps doing that, he could I mean, this could go exponentially higher and go through the roof, but it could also go to zero and his company could be bankrupt. So, it's basically what he's doing is a leveraged play on Bitcoin, which I can appreciate. I don't invest in MicroStrategy just for reference. I'm just using it as illustrative purposes because you can see this craziness going on. It's almost like one of those meme stocks. I mean, honestly, it's just trading like a meme stock now. But if you kind of go back to Bitcoin price, you can see here, like, I think what happened was, oh, I'm going to buy 300 million of Bitcoin. Well, if you say you're going to do that, what are people going to do? They're going to go out and buy in Bitcoin right ahead of that. And so, he's basically taken more Bitcoin off the market, which means there's fewer Bitcoin trading. So if you think about the Bitcoin market, and actually, I use this for illustrative. Forget the fact it's Bitcoin. You could take any of these things. But knowing that there's only a certain number of Bitcoin, right? And principally, they're never going to make any more once they printed the last one. And for right now, there's like, I don't know, 1.5 million left to print. So most of them already are out. But let's say they never printed another one after today. You've got a fixed market with a fixed number of coins. And let's say there's 20, just to make the numbers easy. So there's 20 million Bitcoin, and they're never going to make another one. Well, there are 20 million out there. Phil might have one. I might have one. Bunch of other people have them. But if our philosophy is going to keep going higher, then there's no incentive for me to sell it, which means it's not really on the table because no one's using it. It's just in my drawer. By the way, I don't have any in my drawer, so please don't rob my house. They're in they're in an army base protected by a lot of armed guards, so that's where you can find them. But anyway, so if you look at that, let's say the government bought like 1 million Bitcoin, for example, and they stuck it in their vault and never traded it. You pretty much have less liquidity. You have less amount of Bitcoins in circulation, because whether you have 20 million or 100 million, it doesn't matter, because if those 80 million are stuck in a bank vault, or let's say somebody lost them, then they don't exist. If you're never going to sell something, it doesn't exist, because it's not going to, even though it appreciates and you might be wealthy, it's paper wealth, because it could go to zero or it could go to the moon, but you're not using it, so it's worthless. So you've got a lot of people you've got these whales and other people that are just sitting on Bitcoin, which means there's fewer and fewer traded, which means that the price is more volatile. As you said, Phil, it's hard to treat as a currency because it's volatile. Well, part of the reason is because people aren't actually using it. They're speculating on it. And so it's just a beanie baby that they're only making a certain number of. And people are trading them back and forth, but most people are just sitting on them waiting for them to go a lot higher. Myself included, by the way. By the way, I don't own the actual Bitcoin. I know some of you truists are going to hate me, but I buy it through the securities markets just because it's easier, because I'm just playing the price like everyone else. I'm just honest about it. I'm not thinking it's going to be the world's going to end, but I'm going to have my Bitcoin here in my hand. I don't, I'm playing it for the price and for the technology and for the trend, as you all should when you're investing. So for me, I just do it in the markets. So don't rob me, please, because that's where my money is. But if you look at what's happening, you can see that at some point this becomes a bubble and people get crazy, and maybe it goes to 1 million, maybe it doesn't. But at some point, people lose their mind and just say, "I've got to own it," and then no one sells it, and now you've got like 3 Bitcoin traded because everyone's assuming it's going higher. Well, I mean, that's just dumb, right? And I think if that's where we end up, then Bitcoin is useless and you shouldn't invest in it at all. Because if you take the extreme case, that's where it goes, right? Because if everyone's speculating and no one's using it, then it's worthless. It's a pet rock, right? It's whatever. So anyway, that's kind of my 2 cents. But I did want to share that just because I think it's a good example of investing, of what to do, what not to do, and how to think about some of these trends, because there's other trends. There's AI, right? AI is the big boy in town that everyone's talking about, and it's not going away. It's probably going to get more and more crazy. But you have to understand how to look at trends and how to dissect them and to see what is the thing that's going to capsize the ship. And this is the same conversation that we've had before in the past about the S&P 500, is that what is it, like 60% or 70% of owners of the S&P 500 are indexers. So at what point do the active managers control the stocks? Because the passive ones never sell. So you pretty much, that doesn't exist. So you've got a smaller and smaller float. Let's say the S&P 500 is 95% owner of all securities. Then you got the 5% that are moving the price because everyone else is just buying and holding. They're not selling. There's no trading. So that's the thing that you have to think about, is when you get this craziness where all these indexers are like, oh, indexing is the best thing. It might be. I'm not saying it's not. But if everyone indexes, it doesn't actually work. The mechanics of it doesn't work. It's like saying, well, everybody owns 5 pieces of gold. Well, of course they don't. How do you know what gold's priced at? You don't, because no one's trading it. And that's what you kind of get into in the extreme case. So I know that's not where we are now, but if you keep playing it out directionally, that's where it's going. And then what's the point? You're gambling. So I think that we should just be mindful of those things. It doesn't mean you shouldn't index. It doesn't mean you shouldn't invest in Bitcoin or all these other things. It should be that you understand how the markets work, because that's your path to success. It's not who has the best fundamentals or who's got the best technology. It's none of that. It's understanding how the system works so you don't get run over by the train while you're sitting in the middle of the train tracks. And that's what happens to a lot of people. And so people are buying Bitcoin like it's going out of style. It's going to sell off at some point. I don't know where that point is. I think, I don't think we're there, but I think we're probably close to it. And then what happens? Well, you got to lick your wounds and come back. But you got to be prepared for that. You got to be prepared for that to happen. If you're not, you're going to be really mad. Don't be mad. So anyway, what are your thoughts, Phil? I know we're kind of getting close to time here, but.
So one of the things that I think about when you're making those comments is the idea that there's a lot of stocks that happens to also, right? You can own stock for a long time, and if you're a long-term buy and holder, those shares aren't traded either. And so that supply and demand of shares is a factor. And I don't remember the numbers, but I know JP Morgan, they put out a study talking about how there are so many stocks that they hit a number, whatever it is, and they never get back there. Like, think about going back to the internet bubble and Cisco. Cisco's never been back to the levels it was at during the internet bubble. Intel either. Microsoft went down and it came back and it's far surpassed those, but there's plenty of companies like Intel and Cisco that hit numbers that they never got back to. So that can happen to anything. You have to be careful. You have to know that just because something hit a new high, there are some people who like the idea, if you're trading with momentum, new highs are good, right? You want to keep seeing new highs hit, and we all want to see our stocks go up. But at some point, just because it hit that number doesn't mean that was the right number. So I can get to a number and it can get cut in half. And you look and say, oh, well, it's trading 50% below where it was at one point in time. But that doesn't mean that was the right price and it's going to get back there. So you have to be careful that you don't just focus on the numbers that the sun said.
Yeah, I agree. Well, one thing you brought up before the show, Phil, was small caps. Do you want to talk about that? Because small caps have actually, if you look at things that did well after Trump got elected, small caps are one of them. People were optimistic about it. So what are your thoughts about small caps?
So that's very true. Like I looked at a number of the small cap ETFs that I follow, and if you look, they spiked a lot on the 5th. They pulled back some, and they're now almost back to where they were. But small caps has done pretty well since the election. And part of the reason for that, to me, is the idea that if we bring activity back to the U.S., that benefits small caps because their business is primarily a domestic business. So the more business we do in the U.S., the better that is for them. There are some other things like higher interest rates can hurt small caps, but from a business and economic perspective, the reaction tied to the idea that small caps could benefit from the policies of Trump. The big question I have about small caps is, if you look at it historically, small cap value is one of the best, if not the best, performing stock sectors over the long haul. But it's changed. If you look at small caps now versus where they used to be, we used to see that companies, when they went public, they were really small. Like, I have a client that's owned Apple since 3 days after its IPO. they had 10 shares that they purchased for $300 and just like $340. Now that's 2,100 shares because of all the stock splits, and it's worth a lot more than it was then. But now when these companies go public, it's very different. They don't come public as small caps anymore. Airbnb, that wasn't a small cap when it came public, and there's plenty of other companies like that. When they come public, they're large caps because venture capitalists take stakes in these companies, they hold on to them for a long time. So I do wonder if some of that small cap effect that says small caps you're gonna own them and they're gonna rise through the ranks and become large caps. I think that's gotten a lot harder. There's certain areas of the market where companies come public a little bit earlier because, like the biotech sector would be a good example, because they need capital because they're doing R&D and trying to develop new drugs and they don't have the capital. So they will sometimes come to the public market to get it. But I wonder sometimes about small caps if they have the same, like if you look at the Russell 2000, there's so many companies in the Russell 2000 that don't make any money. And so the valuations can kind of look off. If you compare that to the S&P 600 small cap, you have a lot that they have profitability as a criteria. So that's a little bit different. But just in general, I think this environment could be good for small caps. I just wonder that whether or not they can have the same long-term staying power that we've always seen when a lot of companies are just bypassing small cap, even bypassing mid cap before they ever get to the market. So I think that this is a time where I know we say be careful when you say this time is different. There are some reasons for me to think that it's different because of the fundamentals of what's happening in the market. It's not the same as just saying, oh, it's different for other reasons, but there is a fundamental difference because companies are coming public so much later. But in general, I do think it looks like it's a good environment right now for small caps. And that's why we've seen them be one of the better performing groups of stocks since the election.
Yeah, I've always found small caps to be interesting because if you look back 125 years, if you know, there's a lot of big charts that'll show the 125 years, and the best performer of that period is small caps. Now, of course, that's illustrative because they're trying to promote whatever they're trying to promote. If you look at certain periods in time, some things are better than others. But small caps are more speculative too, and then there's survivorship bias. There's a whole bunch of reasons why that's kind of a BS narrative, but it's not to say that they're not potentially better. But this is, looking at here, just showing the chart for like the last last 5 years. You can see that it pretty much went sideways up until COVID dropped, and then it spiked, and then it's gone sideways since 2021. And if I go back months, you can see this a little bit more illustrative to the early 2000s. There were times where it went up and then went down and went up, and a lot of sideways. It's not. It's funny because as you were talking, Phil, I was thinking about it. Somebody made this comment a few years ago, and they said mid caps are the new small caps. Because if you look at mega caps, they're enormous, right? $1 trillion companies. You look at large caps, they're also enormous. Small caps, the range hasn't really changed. Like it's still like under $1 billion or whatever. It depends on the range you're using, but like micro caps, small caps, like those ranges generally haven't changed. But mid caps have, because the mid cap is basically it's above small, it's below large, and so it's widened quite a bit because mid caps, even though it's an asset class, people don't really pay a lot of attention to it. They used to pay attention to large and small, and mid cap kind of got ignored. But the problem is so few people can invest in small caps now because the companies are small and there's so much money chasing it that you're actually moving the market. So a lot more people are getting involved in mid cap. So to me, it makes me wonder, like, are mid caps the next small cap, and should you be looking at that? And I think that you tend to find a lot of opportunities there. Because the other thing to think about is a lot of markets are moved by institutional money. So if institutional money is not going there, then do you really want to be there? Right? I mean, just look at the Magnificent Seven. Institutional money's pushing that. It's not that they're not worth it. I mean, you could argue that, but it's because institutional money is pushing it. And they're not pushing microcaps because you would buy the whole company and it wouldn't even make a dent in your performance. So what's the point? So I think that's one of the challenges when you get into the smaller range is you can buy value companies, but if if no big money ever comes in to realize the valuation, then it's worthless. And, it's not going to move in the way you want. So the dynamics of the markets are really interesting. And I do agree with your sentiments, Phil, on the small cap trade. I do think there's a lot of potential there, and it's really interesting. So I'd be very curious to see where it goes. But small caps are also getting outcompeted by the large caps. If you really think about it, like basically any large companies is just gobbling up all the business. There's only one Amazon. There's only one Microsoft, right? There's more than one Meta, but there's only one Google. Like there's a reason for that. It's because winner take all in technology. You don't need two Microsofts, right? You kind of do with Apple, but Apple has more or less pivoted away from being a Microsoft competitor like they did, 20 years ago. But there's a reason there's only one, because it doesn't make sense for them to compete. It's much easier there to be one Walmart, one Amazon, and so all these companies, it's winner take all. And then you think of the banking sector. If you're a small bank, you're competing with JP Morgan or Bank of America. That's really hard. They got the economies of scale. Their costs are as a percentage are a lot lower because they got more people and they can spread it around. But you're a small bank, you got to hire a compliance officer, you got to hire this officer, you got to hire this, and it's like that costs a lot of money. But JP Morgan has to pay the same amount. They just spread it out over trillions of dollars. It's easier. So one of the challenges with regulation in the economy, and this is actually one of my bones to pick with capitalism. I shouldn't call it capitalism, it's corporatism in this country. But it's basically when you have regulations, when the government overregulates industries, all they're doing is they're making the entrenched players more entrenched, because it's harder for anyone to come up and compete with them. So the big players don't mind because they'll spend the money, because they're basically routing out competition by the government doing it for them. It's an old game that's been going on for a long time. It's not administration. It's been going on for decades. But it's a real problem. And that's why regulation is terrible for the economy, because you're making it less competitive for the smaller players to outcompete the bigger players. So you never have one of these big players unseated, because it's just, you can't start a new one, right? I mean, try to start a new airline. Good luck. Like there were times people could do it, but good luck doing that. It's hard. It takes a lot of money and huge regulations. It's low profit, all that stuff. Car companies. I mean, other than Tesla, which came out with a new technology, there are no new car companies. Like it just doesn't happen. So, you have to understand that when you're looking at anything other than the large cap, you've got these competitive disadvantages in certain industries. So it's just something to be aware of. Phil, you want to wrap us up here in the interest of time?
Sure. And when we talk about that consolidation, everything that happens too, even in our industry, Kirk, it happens, right?
Mm-hmm.
Because it's hard sometimes for companies to find growth. So that's the other thing that happens is the large companies, they go and they buy out the small companies because it's an easier way for them to grow. And if they can do it at a good price, then they're willing to do it. And it happens in any industry. I know it's rampant in our industry. I'm not looking to be part of that, but I know that there are people that do. And the big players, they're kind of taking it over. Thanks for having me today. As always, Kirk, enjoy the conversation. I know that experiencing big life transitions can be stressful, and my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you're facing new beginnings, you can take our Flourish Through Life's Big Changes assessment at apprisewealth.com/assessment to discover how ready you are to embrace and thrive through your significant life transition. You can also sign up for our blog. Thanks for having me today, Kirk.
Yeah, thanks for coming on, Phil. And that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and podcast app if you're choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a shorting and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do.